Everyone's talking about crypto again, but not for the reasons you might think. This time, it's not hype, it's not memes, and it's not retail mania pushing prices. It's something much bigger. We are watching the largest and most significant institutional adoption wave in cryptocurrency's entire history, a seismic shift that could redefine global finance for decades. Today, I'm breaking down exactly why crypto is entering a once-in-a-generation moment, and why many investors believe right now is the most critical entry point before the institutional floodgates fully open. For years, cryptocurrency lived on the edges of finance. Fascinating, disruptive, volatile, but not yet taken seriously by the world's financial giants. But that era is over. In the last 18 months, we've seen something truly historic. The world's largest financial institutions, the same institutions that shape global markets, are moving aggressively into digital assets. BlackRock, the largest asset manager on Earth, didn't just dip a toe in. They launched Bitcoin and Ethereum ETFs, lobbied for regulatory clarity, and began integrating blockchain-based infrastructures. Fidelity is offering Bitcoin in retirement accounts. JPMorgan is running blockchain settlement networks. MasterCard and Visa are onboarding crypto rails globally. This is not experimentation. This is not a pilot program. This is full-scale adoption. And here's why that matters. When institutions adopt an asset class, capital flows become long-term, stable, and massive. Institutional money behaves differently from retail money. Retail investors chase trends. Institutions allocate strategically. They don't invest for a weekend. They invest for decades. Here's what institutional adoption means for crypto. Institutions don't buy and sell emotionally. They follow structured strategies, often allocating a percentage of their portfolio to emerging or alternative assets. Even a 1% allocation from global institutions represents hundreds of billions of dollars flowing into crypto. Larger players mean deeper markets. That reduces volatility over time and makes crypto safer for additional corporate and government-level participants. Institutional investors create demand that doesn't disappear in a bear market. They rebalance, accumulate, and scale gradually, giving crypto a level of resilience it never had before. Once these players enter, the asset class moves from experimental to mainstream. And when assets become mainstream, allocations increase dramatically. This is the exact same pattern we saw when institutions moved into gold in the 1970s, into emerging markets in the 1990s, and into tech during the early 2000s. Each time, valuations exploded. Not from hype, but from structural capital inflows. Let's talk about what might be the biggest catalyst of all: spot Bitcoin and Ethereum ETFs. These ETFs are a gateway, a bridge between the crypto world and trillions of dollars sitting in traditional finance. Before this, most investors, including institutions, couldn't touch crypto due to custody issues, regulation, or internal policy restrictions. But now, wealth managers can buy crypto with one click. Pension funds can allocate through compliant, regulated structures. 401k providers can offer exposure without touching an exchange. Family offices can add BTC or ETH alongside stocks and bonds. This changes demand permanently.